Very good evening, friends. I welcome you all on behalf of BSE Brokers Forum, and today we have organized a seminar on dual GST, a tax reform or a business reform. BSE Brokers Forum has been instrumental in keeping seminars on the topics which are related to member brokers, either in operations, compliance or in business development, and accordingly we try to get speakers the best available from the industry within our capacity so that knowledge dissemination takes place. Without making much time, I would invite Sri Shailesh Seth, who is an advocate and a senior advisor in direct taxation to BDO India LLP. Sir has been kind enough to grace a lot of seminars in the past also related to service tax, other things which have helped our member brokers. In fact, in service tax, we had 3 seminars in which there was quite good participation and the queries of individual brokers were also solved. Today, this is a seminar on goods and service tax, which is going to be the biggest tax reform in our economy. Without taking much time, I would request Shailesh sir to carry on with his presentation.
Good evening, friends. Again, as usual, I'll start with my very favorite quotations by Hugh McLennan. Because that particular quote by McLennan appears to be the eternal, just as the taxes are. So, McLennan says that man is a taxing animal. Man is a thinking animal, a tool-making animal, a fantasizing animal, a political animal, a building animal. But in the twilight of civilization, he is chiefly a tax-paying animal. So we are all destined to be tax-paying animals till we breathe our last. It is famously said that change is the only constant in the life of a human being. But then there are 2 exceptions to this eternal principle, and that there are 2 things which remains constant in the life of a human being. One is death and another is taxes. And both keep company with each other. So taxes do not leave a human being till he breathes his last. The message is also implicit that if you want to get rid of the taxation burden, one may have to die. That is the only message we can get it. And if you really don't believe this, then see the last entry of the negative list under service tax, which excludes all the services relating to crematorium, burial and the last rites. So the message is very loud and clear. With this some sober thoughts, let us now move to the most grandest of the grand reforms, which is now knocking at the door of the Indian economy, and that is the introduction of a full-fledged goods and services tax or VAT, value-added tax, in the field of indirect taxes. Unless something goes drastically wrong, the reforms are going to be introduced from 1st April 2016. And the possibilities seem to be much, much brighter, with the 122nd constitutional bill being already tabled in Lok Sabha on 19th December and is expected to be passed in the current budget session of the Lok Sabha. In 1 year, you will see hectic of activities, tremendous activities on the field of, as far as the GST is concerned, followed by place of provisions of service rules or place of supply of service rules, it will be. Then again we will have the central GST bill, draft central GST bill, draft state GST bills, which will be obviously be ratified by 2/3 of the states. And finally, the law is expected to be implemented from 1st April 2016. Considering the fact that prior to introduction on 19th December, there have been, yes, there are definitely doubts, there are skepticals who probably feel that GST, as usual, government after government, year after year has been promising about GST, introduction of GST. And it is like in Gujarati, we have that famous child story about the tiger has come, tiger has come. Those who study in Gujarati, they know that ke વાઘ આવ્યો, and finally જ્યારે ખરેખર વાઘ આવે છે ત્યારે કોઈ જાણી નથી શકતું એમ, કારણ કે દરેક વખતે એનો અંદેશો ખોટો નીકળતો હોય છે. Something like that may happen, believe me, as far as GST. Up till now, GST will come, and one fine morning, nobody would really know also what has hit really them so hard, and how come the GST got introduced overnight. So, and this is not a simple reform, friends. As we will see in another 1 hour or so, this is not going to be a simple reform. To call it a game changer, to call it a most fundamental reform, to call it a most radical economic reform, to call it a most basic taxation reform, name it, and it really fits the bill. In the history of independent India, such type of grand reform has never taken place in the field of indirect tax. And compared to GST, which will be sweeping this entire field, the DTC, which is again is expected, and maybe new draft DTC and all, DTC is nothing compared to GST. Absolutely nothing. GST is going to change the way the trade and industry conduct their business activities. It is going to change the way the consumers will be spending their money. It is going to change the way the taxes are being collected, the laws are being implemented. So it is going to change the very face of the economy in few years after its introduction. And this has been the story everywhere throughout the world. So in a nutshell, the life will not be the same again for anybody in this country once GST is introduced. Be it manufacturer, be it service provider, be it professionals, be it distributors, stockists, retailers, salaried people, or even consumers, or most of them consumers. The life will not be the same again. The topics which I intend to cover are all there in the next. Let us right now see, what is the status of Indian economy per se? A brief note next. The Indian economy by purchasing power parity is the third largest economy in the world as of now. It is 10th largest in the world by nominal GDP, and it is likely to be the third largest economy in the world by nominal GDP by 2030. So in another span of hardly 15 years, from 10th position, we are likely to be the third largest by nominal GDP. And finally, in the size, we will be similar to United States, the largest economy in the world, by 2050. In another 3 decades or so, we will be similar in size as far as the GDP is concerned. Now, to make this happen, there is no denial of the fact that you need the best and most effective and efficient tax regulatory systems, whether it is direct tax or whether it is indirect tax. The next. Now here, again, just understand the overall background where we stand today. Otherwise, probably there is a likelihood, there is an apprehension that you may miss the point. What is the importance of GST from all perspectives? So I am taking you through some past historical data as well as the present status of the Indian economy, and particularly as far as the taxation aspects are concerned, and how what is the state of the rankings as far as the ease of doing business in India is concerned or not. If you see, next, fine. India, amongst the 189 countries, as per the latest ranking of 2014, our ranking is 142 as far as the ease of doing business in India is concerned. In fact, we have slipped by 2 points compared to the previous year. That is one. And as far as the ease of paying taxes in India is concerned, even if a person is willing to pay tax, then even in ease of paying taxes in India also we are ranking at 156. So even to pay the taxes also is difficult in this country. And after the new government has taken over, the one phrase which is repeatedly being announced, which we repeatedly come across, is we want to make India, the ease of doing business in India, we want to increase that by any means. And that is the promise given by the new government. And it is understandably so. Whatever, I mean, the factors are all known to us, that why it is so extremely difficult to even enter into any business venture in India, to start any business venture in India. And we have seen in last few years a lot of turbulences and lot of, so much so, there has been the new words, unfortunate phrases like tax terrorism and all that, which has started doing the rounds in the country. Not a very healthy situation to be in. Now, it is imperative that if we were to achieve our goals of becoming one of the largest economies in the world, then our tax and regulatory system have to be fundamentally revamped. Otherwise, we will be where we have been for all these years. Nobody denies this fact, nobody can deny this fact. And it is in this context that GST could be one of the biggest tax reform which can take place, which over a period of time will make the doing business in India an extremely attractive and easy proposition. How? Again, we will see that next. Impact of GST in some, let us go into some statistics. Empowered Committee of State Finance Ministers, which was constituted in 1990 under the chairmanship of Dr. Asim Das Gupta, economist, and at the material time the finance minister of West Bengal. And this committee was actually instrumental in bringing the VAT into all states from 2005 onwards. And the same committee, no doubt the chairman have been changing over a period of time. That empowered committee is right now working on the GST design. In 2009, empowered committee submitted its report on the likely impact of GST. And at a very, very conservative estimate, they have actually projected that with the full-fledged introduction of GST, the increase in India's GDP will be in the range of 0.9% to 1.71%. Translated into dollars, it will come to about $7 billion to $14 billion. I'm coming to that. Yeah, I'm putting this as these are all thoughts at the which I have parked at the back of my mind. I'll be coming to that. Just then the long-term impact will be almost 2.5% GDP. I am directly quoting from Dr. Vijay Kelkar, the chairman of the 13th Finance Commission. In his chapter 5 on GDP, he has projected, he has called GDP as a game changer, and the increase in GDP is to the tune of expected to be 2.5%. and which translated into dollar terms will work out to approximately $325 billion to $637 billion in the form of GDP. And export gains are also expected. Exports are going to be booming in the country after GDP is introduced, and that will be 3.2% to 6.3%. GDP is likely to ultimately, the introduction of GST is likely to lower the overall tax burden, compliance cost, the final price which is being paid by the consumer, and ultimately it will result into the productive employment to the tune of about 4 to 5 million a year. Next. Having said so, what is GST and why GST? GST, I'll just do only next. The GST is basically a broad-based consumption tax which is levied on the basis of destination principle. It is a single unified tax on goods and services which is levied at every stage of the supply of goods or services, right from production till the retailer level, and during which in this entire economic chain of supply, irrespective of the number of people situated into this entire chain of supply, each and every person situated on this chain is expected to pay GST on its supply, whether of goods or whether of services, but it is levied only on the value added at each point of the supply, meaning thereby that value addition is only taxed, and finally the tax is stuck to the consumer, and there it stops. See, it is a destination-based consumption tax. GST, to put it other way around, internationally it is known as GST is a general turnover tax on the consumption. Ideally, it is a tax on it is known also as a tax on a private expenditure. Private expenditure not meaning by private individuals. GST is equally leveled on the government bodies, non-charitable organizations as well, and even any other non-corporate entities and all. But basically it is a tax on the consumption, and it works on the destination principle. The unique features of GST are twofold. One, it covers each and every transaction involving supply of goods or services, irrespective of at which stage of the supply chain person is situated and what is the status of the person. That is first part. And second is, it only captures the value addition. Tax is levied only on value addition, and this is achieved by granting the credit of whatever tax is paid at the input stage. Whether GST is paid on the goods or whether GST is paid on services, at the input stage whatever GST is paid, the credit of it is being granted. What right now we are calling as a SENVAT in the context of service tax. GST also works on the identical principle. No doubt there are other methodology, addition method, capital addition method, subtraction method, but world over, barring a couple of countries, world over where the VAT or GST is practiced, and the list of the countries goes to more than 165. In all those countries, primarily it is an invoice credit method which is being followed, which right now we are following in the context of SENVAT credit scheme. On the same principle, GST is also going to function. Credit is given, or is popularly known as a ITC, input tax credit. That credit is given of the GST paid at the input stage, and it is allowed to be offset against the GST payable on the output activity. So effectively it is only the value addition which is captured, and it stops at the retailer level, because from retailer to consumer, when the goods are being supplied or services being supplied, consumer being, it is a tax on consumption, consumer, there is no question of consumer taking any credit, so the tax sticks to the last consumer, but consumer effectively pays only on the value addition, not otherwise. So this is how it is likely to lead to the reasonable level of the prices on a medium to long term level. Next. Now why GST? Friends, if you see, next. The present indirect tax structure in India, we are ours is a federal country, whereby the taxation powers are distributed amongst the center and the states by constitutional design. And we cannot change that overnight, we cannot actually do anything about it. powers are well defined. There is a union list 1, there is a union list, and there is a state list. And then there is a concurrent list under articles. Now, under that list, the powers which are defined, the states cannot. What are the different type of taxes which are being levied? Central taxes, the prominent being excise duty, service tax, additional excise duty under General Importance Act, additional excise duty textile and textile articles act. Then we have the special additional duty on imports, which is in lieu of the sales tax at 4%. We have CVD countervailing duty, which is in lieu of excise duty equivalent to the excise duty on imports. Then we have central sales tax. No doubt, central sales tax is levied by center but distributed among the states. And finally, we have lots of cesses, research and development cess, and we have so many other cesses and surcharges. These are the prominent indirect tax. At the state level, we have state VAT, that is the basic, or what we call as a sales tax. Then we have entry tax, local body tax, we have octroi, entertainment tax, purchase tax, luxury tax, and we have also taxes on advertisement, taxes on newspaper, taxes on lotteries, betting, gambling, etc. These are the plethora of taxes which are being levied at the central level and the state level, and also the third tier of the government, that is municipality. That also, these are all the taxes which are being levied at present on directly or indirectly on the goods or the services. The next. These are the rates. I will not go into that. Next. Next. Yeah. The problem arises because of this. When a person, let us take a case of manufacturer. A manufacturer engaged in the manufacture of any goods is expected to consume not only the raw materials but also services for the manufacture of his final product, and later on for the sale of the final product, whether in the domestic market or for the exports, if he is engaged in the exports. When he procures the raw materials, he pays generally excise duty as well as state VAT. If he procures it from outside the state, from another state, he pays CST. And he also avails various services of the various services who are paying the service tax, who are charging in the service tax. Now, after factoring into all this cost of raw material, landed cost of the raw material, which will include all the taxes which are paid by him directly or indirectly, whether on goods or whether on services, he will finalize the selling price of his final product, again taking into account the market condition, demand, supply mechanism and all. But at least primarily he is expected to figure into all the taxes which are paid by him, whether in the form of the taxes on goods or whether on taxes on services. And this is how we will decide the final price of product. When he clears the product from the factory, he will again pay excise duty on that product, as well as if it is a domestic intrastate sale, he will pay VAT. If it is an interstate sale, he will pay CST. And it will either go to the consumer, or it will go to the another manufacturer consumer, or it may go to the another distributor, dealer, etc., etc. Now, VAT is not salvatable against the excise duty. Excise duty is not salvatable against the VAT. CST is not vatable against the VAT, and vice versa. He pays octroi or LBT or entry tax, which are not vatable. He pays service tax. Service tax cannot be offset against the VAT or CST, and vice versa. Again, the part of there are exclusions built into the service tax, input service definition, Rule 2L of conservatory tools. There are inbuilt exclusion in the input definition, Rule 2K, Conservatory Tools 2004. So even though they are connected with his manufacturing and clearance activity, even though he is paying excise duty or VAT on these products or service tax on his services, which are actually consumed by him for the purpose of manufacture and sale of the final product, manufacturer does not get the credit or set of benefit of all these taxes to the fullest extent. And because of that, what happens is that when he pays the excise duty and VAT or CST on the final product, a part of the tax is also paid by him on the taxes which he has paid on the raw material or services or input services. because he is not getting the full set of. I hope कि आपको समझ में आया है, right? Or do you want me to explain in Hindi? I think it's very clear proposition, correct? So this is known as the quantum of taxes, whatever taxes in whatever form, whether on goods or on services, are well procured by him and consumed by him at the input stage and even for the distribution or sale of the final product, which he does not get the credit or offset of, that becomes the tax on tax, and that is known as a cascading effect of tax on tax. And the world over, this cascading effect of tax on tax has been a matter of concern for all the economies of the world, for all the tax policy experts and taxation experts, that how to avoid or minimize this tax effect, cascading effect of tax on tax. And from this, the idea of GST has emerged. The question here is, in India, right now, the present indirect taxation structure is so worse that even after the introduction of the VAT by all the states and 7 union territories, 28 states between 2005 to 2009, and even after extension of the Sandwich principle in 2004, integrated Sandwich credit scheme introduced in 2004, providing for the cross-utilization, availment and utilization of Sandwich credit on inputs and services by the manufacturers and the service products are alike. In spite of that, the cascading effect of tax on tax remains. And how, as I have just explained, that the cross-utilization, availment of Sandwich credit, this is one feature of that. And why this is not allowed? Because of there are inbuilt restrictions in the constitution itself. Center cannot levy the tax beyond the production level, and state cannot levy the tax on the services. Once the goods leave the production stage, or once the goods leave the factory of the manufacturer, center has no role to play to levy the taxes. The subsequent sale or resale activity which is taking place, center cannot levy VAT or CST, any tax on that sale of the goods or resale of the goods. And mind you, CST, though it is administered by the center, the entire proceeds goes to the states only. So in that form, indirectly it is a state tax only, and it is levied only on the sale of the goods. The other part is, states cannot levy the taxes on services, because the constitution forbids it. So the question of entitlement of the credit or offset of the VAT or CST against excise duty or service tax, or vice versa, or CST against VAT and vice versa, or octroi or LPT levied by the municipality against VAT or CST or excise duty or service tax does not arise at all. And this is all indirectly adding to the cost of the product. Only because the full cascading effect cannot be mitigated or avoided. And the plethora of such taxes which has remained the feature of the Indian indirect tax system during all these years, though we have come a long way, still that has remained a ban for the overall taxation system or design of the country. Next. It was to face with this situation, and this has been a problem most of the countries have been facing over a period of time, that the concept of GST has evolved. Historically, friends, 1919, William von Siemens has been the first person, a tax expert of Germany, who has actually basically advocated the idea of the so-called VAT or GST as we are now knowing it in Germany in 1919. At that stage, Germany also was facing the same multi-stage taxation problems as we are facing now in India, or we have been facing now in India. However, it really did not take off till 1948 when Brazil accepted it. In 1954, France introduced GST against the French production tax, full-fledged GST. In 1967, Canada introduced. Canada also has a federal structure like us, and since then, this tax has never looked back. In the third last of the 20th century, this innovative tax in the field of as a form of indirect tax has taken probably the entire world by storm. In a span of hardly 60 to 70 years, by 2000 already 123 countries of the world were VAT compliant. All the OECD countries, including major countries of the world, including developing and developed countries, except USA. In USA also still the RSP, that is retail sales tax, is being practiced. US is the only notable exclusion from the list of the countries which are practicing VAT. Otherwise, all the OECD countries and all the developing, the latest introduction is going to be Malaysia. Malaysia is introducing GST from 1st April 2015, after about a month or so. So, the Australia, Canada, Singapore, UK, European Union, China, these are the major countries, and these are the countries who are going to be on our horizon, because we will be closely following those countries as far as our structural design of the VAT in these countries are concerned. And what are the advantages of the VAT? First of all, GST, right now all taxes are origin-based taxes. So it means the supply which takes place or sale which takes place, it is in that state, at that state the tax is levied. So if goods are actually consumed in Maharashtra, sold in Maharashtra, tax is levied in Maharashtra, VAT in the form of state VAT, excise duty is also levied on it. And the buyer may or may not get the credit depending upon his status. If goods leaves from Maharashtra to Gujarat, CST is levied, but the income of CST goes to the Maharashtra exporting dealer. It does not go to the Gujarat-based dealer because it is origin-based. And therefore, in origin-based tax, the producing states will always have an upper hand because the income goes to the producing states. Always. GST works as any consumption tax should really work. GST works on the destination-based principle. Since GST is an indirect tax which chases the consumption, wherever consumption takes place, the tax is levied. The tax should be levied at that point of time. One of the fundamental fallacy or defect of origin-based taxation system is that principally then exports will have to be charged because exports takes place from the country to another country and it is origin-based tax, and imports will have to be exempted because origin of the import is outside the country. And that is absurd. If we exempt the imports and if we levy the tax on the exports, it is foolhardy thing to do. But these are the problems in the origin-based tax. In destination-based consumption tax, since it will be the consumption which will be the deciding point, the point of tax consumption or the place of consumption which will be the deciding point for the levy of GST, it means wherever consumption takes place, the GST will have to be charged. If consumption takes place outside India, then tax cannot be levied, therefore all exports will be tax-free. And if the consumption takes place of the goods or services availed from outside India, from abroad, and if consumption takes place in India, then all these imports of goods or services will be subjected to the levy of GST, and it will be equivalent to the taxes which are otherwise levied on the domestic items. Principally, GST on imports shall be equivalent to the domestic taxes which would be otherwise levied. It cannot go beyond the domestic taxes, but it will be levied. Why? Because the consumption takes place in India. And this is how the destination-based consumption takes place. The other part is that there is a complete integration of all indirect taxes in GST. We will see in the coming slides that how GST is going to subsume all the indirect taxes, including excise duty, VAT, CST, service tax and all. It is going to subsume, and there will be only one GST having two components, CGST and SGST. It is a simple and rational tax structure. It is preventing cascading effect of taxes. Why? Because GST will be levied on the single transaction of the supply of goods or services, and whomsoever may be, whether dealer, distributor, stockist, retailer, manufacturer, service provider, all these people will be entitled to take the full credit of the GST paid by them at their procurement or at the input stage. Right now, dealer cannot take the excise duty credit, even though he buys from the manufacturer. He can only pass on the credit as a registered dealer. He cannot even pass on the service tax credit, because he cannot take the service tax credit. Similarly, dealer, distributor, considering the length and breadth of the Indian economy, Indian continent, we have so many people situated on the marketing chain, and all of them only adding to the price of the product without doing anything to the product. So there is a huge gap between the price at which the product leaves the factory of the manufacturer and ultimately when it is bought by the consumer in the ultimate analysis. There is a huge gap. A 4 rupees, 5 rupees toothbrush might cost ultimately 35 to 40 rupees to a consumer only because there are number of intermediaries situated in the marketing chain, nobody doing anything to the product, everybody adding its own margin of profit to the product, price of the product, and also paying the taxes of which they cannot take the set off. Now, GST takes care of this because GST does not distinguish between the status of the person, status of the taxpayers, whether he is a manufacturer, whether he is a dealer, whether he is a stockist, whether he is a semi-wholesaler, wholesaler, retailer, service provider. It will be levied on each and every transaction of B2B nature, that is business to business nature. In case of B2C, business to consumer, GST will be levied, but there the chain will stop. Because the consumer will be consuming that product or service, he cannot take the further credit, he is consuming. But all the transactions of B2B involving the supply of goods or services will be covered under GST, and each and every person, irrespective of nature of his business activity, nature of his status, will be entitled for the credit which he is being paying at the input stage, at the time of the procurement. The other part is, obviously when you are dealing with only one single law, principally, there will be two laws, but principally GST law, your compliance cost will get reduced, the law will become simplified, credit will be available across the supply of goods and services. Even in case of interstate purchase, right now we are paying CST, that is not sum-vatable or that is not vatable. Under GST, even interstate purchases which will be subjected to GST, full credit will be available. Under the rates and everything, we will see that. Now coming to how GST is going to lead to the increase in GDP and how it is going to have a game-changing effect on the Indian economy. Friends, one of the significant impact of GST, by now we would have realized that GST, which is expected to work on the invoice credit mechanism, invoice is going to be the heart of the GST. It is the hallmark because it is an invoice credit system under which it will be operating. And it means that person decides its GST liability on the basis of the invoice, and person takes the credit of the GST also on the basis of the invoice of the suppliers. Invoice is going to be the hallmark. Now that being the case, and it is going to cover each and every person situated on the supply chain, the parallel economy, or OGL as is famously known, Open General License Economy, meaning thereby the black economy, is likely to come under tremendous pressure because the transactions are all expected to come on records under GST system. It is not possible under GST system to continuously arrange for the complete supplies of the goods or services without any records, without any invoice, day in, day out, right from manufacturer to retailer. Once in a while, it might be. The important thing is, please understand, a retailer may be tempted to evade GST because consumer does not want to pay GST. You go to any market, I mean this is again a universal problem. And it is not only the entrepreneur, whether service provider or manufacturer, even the local, the ordinary consumer also a tremendous allergy to pay taxes. And all of us are coming under that list. We don't like to pay the taxes. When we go to buy some switches and tube lights and bulbs and all that, we go to Lower Jar where my office is. I go down and he says to me, I am going to charge you 12.5%. I say, no, I don't want the bill. So consumers' aversion to pay the taxes has been a problem all over the world. So the retailer says, okay, fine. Retailer does not pay the tax, but retailer would have purchased these products from the wholesaler on which he would have paid the GST. So he is running the risk of losing that set of benefit of that GST because he does not prepare the invoice. And the loss of the government also is limited to that last retail transaction where the GST is not paid because invoice is not raised. Now this cannot continue. Again there will be a complete audit trail. And in the entire marketing chain, even if the one person is caught, everything will be caught. Now these transactions which will come on the records as a parallel economy over a period of time, it will have a multiplier impact also on the income tax collections. Because when a person evades excise duty or VAT, he also evades income tax also. So this will have a complete huge impact on the direct tax collections also. GST, since is uniformly levied on each and every person engaged into the activity of supply of goods or services, there will be a tremendous widening of the tax base. And this is how it is going to lead to the GDP increase, it is going to lead to the increase in the effective, productive, employment over a period of time. Other important feature of GST is a most efficient, meaningful and productive tax system is that which does not influence the decision of an entrepreneur where to start the production, where to set up the factory, and by what means I should really produce the goods, manually, semi-automatic, fully automatic. Where do I go? Whether I go to Batti in Himachal Pradesh because excise duty and cell tax is not there? Shall I go to Uttaranchal? Shall I go to Hardwar? Shall I go to JNK? Shall I go to Kutch? This is the anomalies which are right now in the country. Area-based exemption, exemption notification, under excise, VAT exemption under VAT. Now these are all influencing the decisions of the entrepreneur as to which product to manufacture, how to manufacture and where to manufacture. Not only that, even after manufacture, he is also influenced as to what should be my marketing or distribution pattern. So if I am going to pay the CST, I will set up the branch or warehouse or stock transfer in Gujarat, and from Maharashtra to Gujarat or Maharashtra to another state, I will indulge into the stock transfer, I will stock and sell so that I can avoid the CST. Now this is a very bad system. A tax cannot be a determinative factor for an entrepreneur to take a business decision with regard to his business activity. GST obviates this because irrespective of the status of the business, the manufacturer or service provider or the taxpayer, the product or services in which he is engaged in supplying, where he is supplying, how he is supplying, GST is neutral to business process, business houses, small, medium, large, the technology employed, whether it is manual production, whether it is a semi-automated, fully automated, whatever may be the model, organizational setup, GST is entirely neutral to all these aspects. Because it is concurrently levied, uniformly levied on each and every transaction of the supply of goods or services. Then next. There are these are the certain slides on international experience, the certain major countries who have introduced, whether in the middle of the year, under which economic condition they have introduced, how GST is affected, what has been the short-term impact, what has been the medium-term and long-term impact. There is no denial of the fact, as we see, that in short-term GST can lead to inflation in the economy. There is no denial of the fact that how and when is it. Coming to next, average VAT rates of GST is 16.4%, around 16%. The only notable exceptions are Scandinavian countries, Denmark, Sweden and Norway, where the GST rate is kept at 25%. Malaysia is introducing GST from 1st April 2015 and the neutral rate, RNR, revenue neutral rate in Malaysia is actually as of now finalized at only 6%. It is being introduced at 6%. Coming to the recent progress, with this background, what has been done up till now, from 2010 when the serious dialogue started amongst the center and the states for the GST introduction, constitutional bill has been introduced and it is likely to be passed in this budget. It is likely to be introduced from 1st April 2016. There is a time chart. What is going to be the coming days in 1 year, how it is going to be materialized and implemented. The proposed structure, next. First, there is going to be a dual GST because of our federal requirement. There is a complete fiscal autonomy given to the states. So, states government has to be given the powers to levy the tax. That cannot be taken away. So, the proposed model, which is now going to be certain now, there will be dual GST, that is central GST and state GST. The central GST and state GST, both these taxes will be levied in parallel on the single transaction, whether involving supply of goods or whether involving supply of service. Therefore, if as an advocate, if I raise the bill on my client, or as a chartered accountant, if I raise the bill on my client, I will charge the state GST and central GST both. A manufacturer selling the product to the first wholesaler or stockist will also charge the CGST and SGST at the specified rates. A stockist selling the goods to the wholesaler or a wholesaler selling the goods to the retailer will also charge the CGST and SGST on the single transaction. There is no difference between an advocate, a chartered accountant, a wholesaler, a retailer, a manufacturer or a stockist. All these people who are engaged in the supply of goods or services in whatever manner, at whatever stage, all will be charging CGST and SGST concurrently on the single transaction, on the single value, in the same invoice. And the other notable feature is that exports are going to be zero rated, meaning thereby there cannot be and there will not be any taxes on the exports, but all the input level taxes which are paid by the exporter, either of service or of goods, that will be refunded to him in toto. Whatever GST in the form of CGST or SGST or even IGST, I'll come to IGST, what integrated GST, which he would have paid for procuring the goods or services for the purpose of his export related activities, whether manufacture and export of goods or whether provision of services for exports. All the taxes, domestic taxes in the form of GST which he would have paid on all his procurement will be entirely refunded to him because exports are zero rated. He will not be per se exempted. He will be zero rated. Under the GST concept, there is a distinction between zero rating and exemption. If the final activity is exempted, no credit of the GST paid at the input stage will be available. If the final activity is zero rated, the credit of the GST paid at the input stage is granted. To the exporter, it will be totally refunded. The other part is on the interstate transaction. Intrastate transaction, it will be CGST, SGST. In the interstate transaction, it will be IGST, that is integrated GST. This integrated GST will be levied on each and every interstate transaction involving supply of goods or services. So if I provide advisory services to my client situated in Gujarat, and if I raise the bill on him on Gujarat, I will charge him IGST. If you undertake any transaction on behalf of your client in Gujarat, you will be charging IGST. A manufacturer selling the goods, manufacturing the goods in Gujarat, selling it in Rajasthan, then from Gujarat to Rajasthan when he moves the goods, he will be charging IGST, which at present it will be CST. This IGST again will be available as a credit to the importing dealer or importing consumer. Provided if he is a final consumer, again there is no question of taking the credit. But subject to that, the importing person in the other state will be entitled for the full credit of this IGST. IGST is basically the component, it is a total of CGST and SGST. Integrated GST will be the sum total of CGST rate and SGST rate. Again, imports as per the 122nd Constitutional Bill, imports are any supply of goods or services from outside the country is treated as the interstate supply. It is deemed to be interstate supply. And being the interstate supply, all the imports will be also subjected to IGST. So CVD will not be levied, SAD will not be levied, basic custom duty will only be levied, basic custom duty will continue as is the practice internationally. So basic custom duty will continue, but in addition to basic custom duty, IGST will be levied because imports are treated as interstate supply of goods or services. So if you avail even any services from outside India for any purpose, IGST will be leviable along with the custom duty as may be applicable. Similarly, any goods which are imported from outside India, BCD, basic custom duty along with the IGST will be levied. The most important part is, and this is going to be one of the major fundamental change which will be brought about because of GST. GST is levied or will be levied on the supply of goods or services. The word used is supply. Neither on manufacture or removal, nor on sale, nor on provision of service. Right now, what is the taxable event for excise duty? Manufacture of the goods. What is the taxable event for service tax? Provision of taxable service. What is the taxable event for the levy of VAT? It is the transfer of ownership for a consideration. What is the taxable event for import or export? The goods crossing the Indian territories, either to another country or from another country. These are the taxable events. After GST introduction, all these taxable events will become redundant because it is on a supply of goods or services. Supply word is much wider than the removal, then the manufacture, then the sale, then the provision. It is on supply. The impact of this will be even stock transfers will become liable to GST. Even branch transfer will become liable to GST. Even repair and return will be liable to GST. Even job work will be liable to GST. Right now, all these activities are one way or another exempted, not levied. If you send the goods for repair and it is brought back to you, it might be subjected to service tax. But VAT or excise is not payable on it. If the stock transfer is undertaken on the removal, because excise is on removal, not on the sale of the goods. So at the stage of removal, you may pay the excise duty. But VAT or CST is not leviable because it is a stock transfer against Form F or against even E2 transaction or against C Form 2%. All these concepts which has ruled the indirect tax rate in this country for 60 years and more at the state level and central level will become totally irrelevant overnight because it is on the supply of the goods or services. And this can have a tremendous impact on the day-to-day transaction of B2B nature between the two entities. The other part is that there will be obviously place of supply rules will be important for the cross-border transaction for service tax, which are actually right now in the offing. We will be mostly following the UK model on that. We will not go into that. Coming to next, imports. As I said, integrated GST will replace CVD and SAD. So it is BCD and IGST. IGST will be fully vettable or credit will be available fully. Right now CVD credit is available to the manufacturer, but CVD credit, SAD credit is available to the manufacturer. SAD credit is not available to the service provider. Because SAD is in lieu of the sale tax. So service provider cannot, he pays SAD but he cannot take the credit. Now all these anomalies are will be the thing of the past once the GST is introduced. Next. Then this is the interstate supplies, how it is going to work. The other part is coming to, this is slightly again a distortion. When the CST right now is 2%, which was brought down from 4%. It was supposed to be phased out, but it never really materialized, which has been the problem of, it is one of contention between the states and the center. Now finally, in order to probably anxiety to bring the states on the board, center has made this one compromise while introducing the GST bill, and that is an additional 1% tax is proposed on the interstate supply of goods, not on services. Right now it is 2% against CFOM. The similar tax will be levied, but it will be 1%. It is expected to be levied for 2 years or for such other period as GST Council may determine. Now this 1% tax will be levied on an origin-based principle. So what will happen? That CGST and SGST or IGST, suppose IGST will be levied when the goods are sold from Maharashtra to Gujarat. In addition to that, 1% tax also will be levied on the Maharashtra supplier. This 1% tax will be levied and retained by Maharashtra state, but IGST which is being levied, the benefit of that will go to the Gujarat-based exporting dealer. Maharashtra will not get it, but 1% will get. So for 2 years at least, we will have this sort of a hybrid structure whereby there will be origin-based tax and there will be a destination-based tax. This is definitely a distortion. This 1% is not expected to be creditable. Set-off or credit will not be available. This will be the direct cost to the manufacturer. There is also right now no clarity whether this 1% additional GST will be leviable on the imports or not. This is going to be a problem. It is a very unfortunate thing to happen, but probably center has thought it fit that this compromise they can do. But otherwise, origin-based tax in the form of maybe 1% and destination-based with the GST is both cannot go together. And particularly then 1% credit is not going to be available. So it is a direct cost. The sectors which are going to be excluded, again here center has scored over the states. States were actually frantically asking for the exclusion of the entire petroleum sector out of GST, because it is forming the chunk of the revenue for the states. Finally it appears that states have come on the board. So if you see, as per the constitutional bill, GST will be levied on all the goods including petroleum and petroleum products except the alcohol for the human consumption, which it will be subjected to the state excise. States even wanted to bring tobacco and tobacco products also outside the GST. But tobacco and tobacco products are already now going to be the part of GST. Petroleum products are covered under the GST net. Only thing, as per the bill, for 2 years, to impose the GST on petroleum or petroleum products, the date will be decided by GST Council. Immediately, it will not be subjected to GST, and therefore it will be subjected to only excise duty, which is the case at present. So excise duty will be continued to be levied on petroleum and petroleum products, refining products, petrol, diesel, and other aviation turbine fuel and all such products, LPG. Excise duty will be continued, but GST will not be levied till the date to be notified by GST Council when it will levy. Again, this is an unfortunate thing, because for the ferrous, non-ferrous metal industry, chemical industry, plastic industry, and certain such industry, the consumption of such items as the fuel, diesel, is a tremendous cost, and on which, if excise duty is paid, and most likely if it is not allowed to be credited, against the GST payment on the final product, it is going to be again a distortive feature, which exactly what the GST proposes to alleviate. They want to obviate that very necessity of cascading effect from tax on tax. Again, if the Indian Oil Corporation or BHEL or the Reliance or SR, if they pay the excise duty on the inputs in the form of goods or services which they will be procuring, they will be paying GST on it. So whether that GST credit will be available to them so as to pay the excise duty on their final products, there is no clarity as on date on this point. But at least some beginning has been made. Instead of keeping the GST petroleum products, entire petroleum sector outside the GST net, which would have been required constitutional amendment, it is covered under the scheme. The levy will be introduced at the date to be notified by GST Council. The other part is, if you take to 33, the taxes which are going to be subsumed under the GST, and please don't misunderstand, CGST will replace excise duty and service tax, and SGST will replace VAT. It is too simplistic to say such things. There is no such watertight compartmentalization between CGST and SGST as far as the subsuming of tax is concerned. The taxes which are going to be subsumed as a whole, the central taxes which are going to be replaced by GST, central excise, all the additional excise duties, additional duty of custom, that is CVD on imports, SCD on imports, service tax, all central surcharges and cesses, education cess and secondary and higher education cess, and central sales tax. As far as state taxes are concerned, VAT, CST which is levied by center and distributed to the states, purchase tax, entertainment tax, luxury tax, lottery tax, state cesses and surcharges, including entry tax, octroi and LBT. All are going to be subsumed by the GST, having two components, CGST and SGST. States were not willing to give up the right to levy entry tax or octroi, but that is also now going. Today probably you would have read in the newspaper yesterday that they are in Maharashtra, octroi will continue for 1 year, but otherwise LBT and everything is going to be removed totally. The other part is, so entry tax, octroi or LBT will be again the thing of the past. Next, what are the rates which are proposed? Here there is right now no clarity. Empowered committee has suggested two rates, 16% on service tax, on services, supply of services, and 20% on the supply of goods, to be brought down in a phased manner to 16% over a period of 3 years. So from 20 to 18, 18 to 16. And services will be straightway levied to 16% service tax. That was what the Empowered Committee had proposed. Right now the talk is already going on, at least slightly apprehensive one can be. States are demanding 27% as the GST rate, comprising of the nearly 12% as the central GST and 14% as the state GST. Personally, and it appears that center is not going to oblige the states on this, but there is a likelihood that the total rate will be in the region of between 20 to 24%. It could be 22 or 24%, may not be 20% initially. IGST will be, let us assume that 10% is CGST and 10% is SGST. Then IGST on interstate supply of goods and services will be straight 20%. Because it is the sum total of the CGST and SGST. So it will be 20%. On interstate, right now we are paying 2%, CST against CFOM. Or otherwise the maximum state levy, which could be 12.5%. It will be state 20%. We will have three structures. One is 1% on precious metal, which is right now 1% VAT on precious metal, or jewellery, or articles thereof, which is VAT. There will be a standard rate, which will be probably 20% or 22%, comprising of CGST and SGST, and there will be a special rate for certain selected products, which is expected to be in the region of 8% to 10%. What are the special rate? Why it is required? Friends, one of the amendments which is proposed by the constitutional bill is deletion of the entry relating to the declared goods which are of special importance, under which cotton, ginning items, plus iron and steel products, notably iron and steel products, and these are all covered under this 5%. Earlier it was 4%. It is now levied to 5% VAT maximum, which is constitutionally mandated by amendment. These items of special importance, goods of special importance, which are known as declared goods, these declared goods, that entry is being omitted as per the constitutional bill. So all these products of, say, iron and steel, TMT bars, flats and all, which are mainly construction material, they will overnight be liable to state 20% or 22%, which could be quite inflationary. So there will be a special rate which I am expecting it to be 8% to 10%, but at least that 5% rate will not be there. So those products which are right now declared goods attracting 5% may attract 8 to 10%. The next. This is from the manufacturer perspective. I will not go into this. Coming to the GST credit. The credit, as I said, credit will be available of CGST, SGST. Cross utilization will not be permitted. So CGST can be used only for CGST and SGST can be used only for SGST. Cross utilization will not be permitted. Number one. IGST credit will be available totally. But how the payment is going to be made? Here comes the innovative model suggested by Empowered Committee, a very unique model. Probably internationally such model has never been tried. A person sitting in Maharashtra selling the goods to somebody in Gujarat, he will charge IGST of 20%. Let us assume that is a total rate. That 20%, that Maharashtra dealer at the end of the month, when he deposits the money, he will use his credit balance in the form of IGST, CGST and SGST. He would have made the purchases from another state, so he would have paid the IGST on it. So that IGST he can take the credit. He can take the credit on local purchases, intrastate purchase of CGST, SGST. First he will utilize IGST to pay the IGST part on his interstate sales. First, in this order only he will have to use. Then he will utilize CGST if there is a deficiency in IGST account. Then he will only use the SGST if both are not sufficient to take care of his IGST liability. And that state GST which he has utilized for the payment of IGST, that quantum will be deposited by Maharashtra government with the central clearing house. That much quantum which the Maharashtra-based dealer or supplier of goods or services utilized for the payment of IGST, Maharashtra government will deposit with center. Thereafter, the Gujarat-based importing dealer will take the full credit of IGST. That IGST, to the extent it is utilized by the Gujarat-based dealer for the payment of the SGST, that much will be deposited, refunded by center to the Gujarat. Here, the taxpayer will not come into contact either with Maharashtra government nor with the Gujarat government. No forms, nothing will be required. Whatever IGST is paid from state account at the time of the movement of the goods from Maharashtra, Maharashtra will deposit with government, central government. Whatever IGST is utilized by the Gujarat dealer for the payment of SGST, that much will be refunded by the center to the Gujarat. So center will act as a clearing house. And this is the model against the bank model suggested by task force. This Empowered Committee has suggested, and more or less this panel will be there, will be through. The other part is what will be the impact. As far as friends, as I was just briefly discussing, stock market, the stock exchanges where the corporate entities are listed, thousands and thousands of. The performance or the future performance of these entities are reflected in the daily price movements which are taking place on the stock exchanges. And the performance of all these entities in whatsoever field they may be is going to be affected in a tremendous manner because of the GST. The impact will vary from one entity to another entity. Impact will vary depending upon the profile of the entity, the portfolio of the products, whether goods or services, combination of goods or services, whether they are right now, whether the bulk of the production is taking place in the exempted category or area-based exemption notification. All these are all going to be the present tax structure affecting the activities of the entity. It was in the context of that the impact of GST will vary on that particular entity. But having said so, all these areas to some extent, more or less extent, they are going to be affected because of the introduction of GST. Once we say about if the stock transfers are going to be charged to IGST from one state to another, overnight to have such type of stockyard or depot transfer so as to sell the product locally and to save the 2% CST, that will become irrelevant consideration. Because if I am going to pay the GST, that is IGST on my stock transfer, and right now the thought process, the thinking of the note block in all our interaction with them is that stock transfers are going to be subjected to GST just as independent supply of goods or services. Now obviously this is going to affect the pharma companies and FMCG companies in a fundamental manner, who have opened up their depots and stocks, warehouses everywhere in the country. So that tax consideration will not influence whether I have to open up the stockyard or not. What will be affected, what will be the consideration for me to open the stockyard or not? Not the tax consideration. It is the business consideration, whether I need to make the product available to my buyer, how fast and to what extent. This will be the deciding factor, not the tax consideration. Again, import will be affected because IGST will be payable on import. Change in taxable event, it will be supply. So my manufacture, sale, ownership, everything will go. Exemption to refund in case of SEZ, refund will be given. The present area-based exemption notification will be the thing of the past. And they will be converted into the cash refund schemes. Then IGST, the other part is the next. It is going to affect each and every of the, we can go into detail, today is not the time. I am only apprising you the broad nuances of the GST structure. Just to making you familiarize with what is in store for each and every one of you. In whatever capacity or entity or whomsoever you are connected with will be. You can take this as a starting point, and over a period of time, over a period of 1 year, it will be worth its while to remain fine-tuned with what is taking place on the GST front. You cannot take this particular tax reform lightly. It is not run-of-the-mill kind tax reform, friends. It is a basic fundamental reform. I can go on each and every aspect of this, and one would realize how it is going to affect me. So take this very seriously. The fiscal cash flow, simple. If I am going to pay IGST of 20% or 22% on my imports, presently I am paying CVD and SAD. It will become state, the sum total of CGST, SGST, let us say it is 24%. If I am going to pay 24% of IGST on my stock transfer, if I am going to pay 24% of IGST on my interstate supply of goods, independent supply of goods or services, right now I am paying only 2%. Even though that 24% is available as a credit to my customer or my client, if it is available, still overnight my requirement, because at the end of the month I will be required to shell out 24% in the form of IGST. My buyer will be required to pay me upfront cash against my invoice in which I have charged him 24%. This will hugely impact the working capital requirement of any entity. The entire cash flow can get affected. Again, it will depend upon the holding capacity of the particular person. Whether it is a fast moving item, whether it is a slow moving item, what is the holding capacity, all these factors will have to be looked at really absolutely. Once again, one will have to go back to their drawing board and start actually calculating the things. Okay, how it is going to affect me. Simplicity or availment of credit will not solve the problem, because I may have to shell out the upfront cash. This is how it is going to affect my cash flow, my business processes. Then the product pricing, I will have to take into account the credit which is available to me. In an ideal GST system, hopefully, and I am hoping against hope, that the bureaucracy will not meddle or mess up with the input definition and input service definition. Because the fundamental requirement of GST is the seamless credit to be made available to the taxpayer on all the input stage purchases of goods and services. It has to be seamless. If they start excluding, on this we will not give you the credit, on this we will give you the credit, then, God forbid, we will have it. And I think some good sense will prevail. So the credit will be available on all the input tax purchases of goods and services. Take an instance of capital goods. I am expecting capital goods, machinery, mechanical appliances, equipment to be charged to only 8% or 10%, that is the special rate, which are right now declared goods, chargeable to 5%. It may become 8% or 10% because declared goods classification is gone. Now capital goods, the credit available is in 2 installments as of now. 50% in the first year of purchase, 50% in the subsequent years. In GST system, such categorization, such restriction cannot have a place. Because there is no distinction between capital goods and inputs. All are goods for me, which I am utilizing for the purpose of my business activity. So you cannot restrict my entitlement to the GST credit which I have paid on the capital goods procurement as a manufacturer or as a service provider, take only 50% this year and 50% in the next year. 100% credit should be made available to me, and it is our expectation that capital goods, this restriction will go entirely. Now those countries, there is a tremendous infrastructure activities taking place in this country which are going to take place in this country for another decade at least. Tremendous. It is going to be the sector of the coming 10 years at least. Infrastructure. Now in this infrastructure related activities, the huge capital investment which are being made by the companies, where the credit is stuck up in 50% and 50% in the subsequent year with lot of restrictions, because capital goods definition is contained in Rule 2A of Central Credit Rules 2004, which is a very restrictive definition. With the GST, no such distinction will be there between GST and inputs. So again, it can work as wonders for the companies who are actually have a huge capital outlays in the offing in the coming years. Simultaneously, they will have to rework their entire cash flows, cash inflows and cash outflows, their working capital requirement also. It is one thing to look into the availability of the stimulus credit. It is another thing to shell out the money at the procurement stage itself. So these are going to be certain examples of the exam. Accounting, because CGST and SGST cannot be cross-utilized, obviously proper accounting will have to be maintained. The whole entitlement to my credit is on the basis of the invoice. So I have to be extra careful that nothing extra or wrongly taken and nothing which is available to me by way of a credit I should miss out. Otherwise I am losing the money. That GST credit is working as a cash for me, which I can utilize. So if I miss out on that, it is my loss. If I take something wrongly, again it can lead to the dispute. It can lead to the litigation. The barring customer, there could be that most of the people would then insist upon the billing and proper billing so that not to miss out on the credit. When the product is moving to the ultimate consumer and he knows that this has actually passed through 3-4 hands. Under the GST system, on the economic supply chain, each and every person situated on that supply chain is merely acting as a tax pass-through. He is acting only as a tax pass-through. He is charging the tax effectively on the value addition and passes it on to the next buyer. And then it stops at the retailer. Retailer charges it to the customer and it is the end of the story. Retailer is the last in the chain. Everybody is acting simply as a tax pass-through window. And the tax is levied only on the value addition. Next. I'll just come to friends. We have only 5-10 minutes, I will just complete. Text, there are slides on manufacturing, distribution, supply chain. Come to straight to 56. This is GST impact on financial service sector. First of all, there are 3-4 slides on this, we will complete that. In any economy, developing, developed, financial service sector is always the chief contributor to the GDP, as well as it forms the major part of the private consumption, one way or another, either directly or indirectly. The problem of levying the VAT or GST on financial services of different nature has been faced by all the economies across the world who are who have actually implemented the VAT. The problem is why because rarely in the financial services, the fee or charge is actually recovered by way of an explicit fee. It is always implicit in the margins. That margin can be either hidden in the interest or in the dividend or annuity payment or like that. The charges are rarely explicit. So when you open an account and deposit the money, if you create a fixed deposit in the bank is giving you 4% or 3% interest. That money is deployed by the bank for the lending purpose on which bank may earn 9% or 11%. But on record it is 4% my outgo, 9% is my inflow. Now this spread between the two interest rates on the inflow and outflow is hidden in the margin. That margin is never visible except at the end of the year on the aggregate income shown by the bank. Now how to levy this? To levy VAT on this type of, it is not possible. So all these financial services in the majority of the OECD countries as well as majority of the countries, the financial services per se have been completely exempted from VAT. Because there are also the problems of determining and identifying the value added on each and every service which is provided by the financial institution. Of whatsoever nature, whether it is in the banking sector, whether it is a pure financial service company, whether it is an insurance company, or whether it is a mutual fund or whatever it may be. Majority of the countries have actually exempted the financial service or most of the financial services from the levy of the VAT. It is leading to the anomaly in the sense that when you are exempted, your output activity is exempted, you are not entitled for the credit of the tax paid by you at the input level. Financial services as an output activity may be wholly exempted, but those companies, say bank or institution, financial institution, will be paying the GST or VAT on their procurement of the goods or services so as to render their output activity. That will not be available to them as a credit. So there is a partial taxation, there is no exemption. Indirectly, there is a partial taxation of the financial services when they are exempted from the tax altogether. Because their input tax credit is irrecoverable, they cannot recover it, they cannot deduct it. So that is the burden they are bearing. One of the fundamental principles to understand the VAT, there is a German tax expert, I cannot actually take the name of it is impossible to pronounce that name, but he has said that VAT is a paradox in that those who consider themselves to be taxed are actually exempted and those who consider themselves to be exempted are really taxed. If you understand this paradox, you have understood the VAT. Because when your final activity is exempted, you are losing the credit. So actually you are bearing the burden of the tax. If your final activity is taxed, you are entitled for the full credit, so effectively you are paying tax only on the value addition, which you are passing on to the next buyer. So basically you are not paying any tax. Because in value addition also whatever you are paying, you are passing on to the buyer. You are only acting as a collecting agent for the government, for the revenue department. And that is why in an ideal GST system, there is no place for the exemption. The coverage of GST will be so wide for the simple reason that moment you start giving the exemption, you are creating the distortions in the economy. You are breaking the credit chain. The whole purpose of GST or VAT is to maintain the complete credit chain and to see that the tax is levied only on the value addition. The moment you start into exemption, one, it will break the credit chain, it will lead to the distortion, there will be rent seeking from the interested vested parties. Our items should also be exempted, our service should also be exempted. Dr. Kelkar in his report has suggested only 5 sectors to be outside the GST purview, completely exempted, education and agriculture and health and all. So this negative list which is right now there, basically it is a step in that direction. Negative list is the last important significant step taken by the government for the early introduction or smooth introduction of the GST. It was not an overnight, they did not have a fit of an idea. Okay, let us now move to the comprehensive taxation. There was a design, there was a purpose behind it. Right now, a gamut of services are now under the service tax which were earlier covered by the specified list. Now one has to only look into whether my service is covered by negative list or not, whether my service is covered by the mega exemption notification or not. If the answer to both these questions are no, prima facie I am liable to service tax. And then I look forward to further taxability. This is exactly is going to happen in GST. With a much wider coverage on a very minimal list of the product or services outside the GST. So in financial services, when you are exempting it, basically you are not helping the cause anymore. Under that, now India, what has happened is from banking and other financial services, almost majority of the services where there is explicit fee are all covered under the service tax. All are covered under the service tax. Indirectly, we are very innovative people as far as the taxing is concerned. So we have been able to even levy the service tax even on the margins also where income is hidden. Which are there? Right now, merchant discount on credit or debit card which are charged by the credit card companies, issuing companies to the merchant establishment. This is in addition to the explicit fee which they charge to the card holder as well as late payment charges which they charge to the card holder. The discounts which are given to the merchant establishment, that is also subjected to the service tax. This is a hidden spread. Next is a tax on deemed amount of consideration equal to 1% in case of the foreign currency conversion transaction under Rule 7A of the service tax rules. Right? And there is another option given that Rule 2B of valuation rules, or another option is 0.12% up to rupees 10,000, 0.15% and 0.18% under Rule 7A of the service tax rules. Here basically it is a ad hoc percentage, but you are actually spread. It is a spread which is being subjected to the tax. Similarly, portion of the life insurance that represents a cover for risk and not the investment portion, that is being subjected under Rule 7A of the STR. Now, all these are expected to continue in the coming GST scenario. More or less in the same manner, this will be subjected to. What are exempted right now are sub-brokers or the authorized person providing the services to a member or stockbroker, authorized person providing the services to a member of a commodity exchange, mutual fund agents and mutual fund distributors. These are all exempted under the mega exemption notification. We will have to see, given principally, theoretically, all these exemptions would go. Theoretically. Now, from the administrative and practical purpose, whether exemption to sub-brokers will continue, whether exemption to the MF agents will continue, we will have to see that. But principally, one should not get a nasty surprise overnight that as a sub-broker, I am providing services to my broker and I am covered under GST. It is a possibility. In UK VAT system, unless the person has acted if the person has acted as an agent for the principal, all these brokering activities and they are all exempted. So they may not continue, we are not sure about it. But principally, one should not, it can get covered and all these exemptions can become the thing of the past. Similarly, the task force has suggested the comprehensive coverage of the financial services. Please keep it in mind. How far they will be able to cover the services, one has to see that. The other part affecting the stockbrokers, apart from the taxes which we have talked about, so far as the stockbroker activity is concerned, there are turnover taxes or transaction charges levied by SEBI, stock exchange, as mandated by SEBI. There is SEBI fees, then there is stamp duty, right? There are demat charges, which are the DP charges. All these charges which are being levied at present, out of which definitely stamp duty is likely to continue. Because stamp duty in relation to real estate transaction will also continue. Though there could be complete coverage of the real estate industry, a very interesting thing, sale of immobile property like home, unless it is a resale, may come under the GST. So stamp duty can come down, but renting of residential purpose and resale of the already purchased property definitely will be kept out of GST. There are some it is likelihood that real estate will be covered as a whole, complete. What is the definition suggested of service in constitutional bill? Anything other than goods. GST is levied on goods and services. Anything other than goods is a service. Therefore, transactions in money, actionable claims, immobile property, license, grant of license, they all can become the part of the GST. We'll have to wait for that. There is a lot of grey areas right now about that. So, stamp duty will continue. What about turnover tax or transaction charges? What about the DP charges? DP charges probably will be subjected to GST. Turnover tax should go. If not, then it will become an added burden because it is unlikely that the credit of turnover tax or transaction charges will be available to you. Security transaction tax probably will go, or at least should go. It should probably go, but unless it is treated as it is a part of the direct tax. So STT ideally should go, but otherwise credit will not be available. SEBI fees and all these charges, which are from the perspective of administrative fees, those fees one cannot really quarrel. The important are only three according to me: the transaction charges, stamp duty charges and security transaction charges. Because even if DP charges are charged, suppose, generally it is borne by the consumer directly. So there it will be subjected to GST. But other charges probably should be either merged, otherwise there will not be, at least credit will not be available, which will probably the added cost as far as the stockbroking transactions are concerned. And the last one is, take only 69. What are the areas one has to look into? From Chief Financial Officer, financial working capital impact on GST, tax planning and structuring for the future, transition of system and process. These are the areas which the CFO would be interested. Then Chief Marketing Officer, impact of GST on his product pricing, impact of supply chain efficiencies, competitive dynamics, because distribution channel will have to be completely revamped. Coming to the procurement and logistic head, GST can have a tremendous impact on the logistic industry, are very positive, because it is expected that there will not be any check nakas in future. No check nakas, except maybe they may install, as per Task Force Commission report, they may install the scanners to see that to really detect the narcotics movement or smuggled goods movement. Otherwise, check nakas will be the thing of the past. If the check nakas are gone, right now 1 rupees 20 paisa or 1 rupees 25 paisa per kg is probably the freight, out of which authoritative announcement from the logistic industry head is 60 paisa goes by way of a corruption bribe, out of 120 per kg. And it has been actually promised that the moment GST comes, our freight will come down from 1 rupees 20 paisa to 80 paisa overnight. And with other requirements relating to RTO, if it is removed, then another 20 paisa will come down. So practically the freight will become 1 rupees 20 paisa kg at present to 60 paisa per kg. Overnight 50% reduction in the freight charges, only because of GST. So my procurement policy will have to undergo complete change. From where do I procure? I will have no that consideration. I procure it from Hardwar, I procure because area-based exemption, no excise duty, no VAT. I will have not that type of consideration whatsoever. And finally, Chief Technology Officer, complete IT process will have to be revamped. GST is completely IT driven. From the government implementing agency, it is imperative because the heart of the GST is invoice. And we know that in this country, invoice itself is sold as a commodity. The biggest business is in the invoice, without material. Government has not been able to find out a way to tax the invoice. If they can tax the invoice as a commodity, there will not be any revenue deficit ever. So, the art of so any transaction, right now we are facing the problem of where bogus dealers the fake dealer, I'm not talking about 2 crore given to our party. The question here is, the dealers are not existing, they are collecting, they are issuing the invoice, they are collecting the tax, not depositing with the government, and the poor purchaser who has actually made a bona fide purchaser is being disallowed the VAT credit. Cases are going on everywhere. These are real possibilities in GST, because these are the problems also being faced all over the world by all major countries. Because tax, the crows are blank everywhere. It is not that in India people have an allergy to pay tax. It is the same story everywhere. There are 16 types of different frauds which are well tabulated, which can take place under GST or VAT system. Please don't ask me which are they. So, and one of them is taking the credit purely on the invoice without material. Then there are carousel fraud, there are round tripping, all these tax having. Australia, European Union, UK losing billions and billions of dollars or pounds every year as far as GST. But it has withstood the test of the time as of now. And there is a lot of churning going on. There are latest papers which are coming out. European Commission is already working on the new design of VAT or GST. They are trying to revamp their entire 112 EC Directive of 1976. All things are going on. Lot of things are taking place. But by and large, IT, and therefore there is a tremendous emphasis on the infrastructure, IT infrastructure from the government perspective. Because without that we are doomed. Each and every transaction should be verifiable in the first instance itself. Whether it is taking place between a person sitting in Calcutta and another person sitting in Mumbai or Kanyakumari to Kashmir. It should be easily verifiable on the system. And that is the heart of the GST. For which we have a separate GST network, GST, and a separate corporate entity which has been set up by the government with 49% and 51%, central and others. We may be subjected to the dual assessment as of now. Whether there will be CGST, SGST, am I supposed to take two registration? Registration will be one. But what will be the audit? Will there be dual audit? Will there be dual assessment? What will be the threshold? I am not expecting more than 10 lakhs. It could be 25 lakhs, but which will be a criminal. If we give the 25 lakhs as a threshold and exempt all people, most of the northeastern states will go out of GST because everybody will be under 25 lakhs. 1.5 crore excise exemption will go definitely. Right now 40 lakhs is the VAT exemption, 60 lakhs audit. There could be a composition scheme up to 40 lakhs. Probably 40 lakhs will be prescribed. Between 40 to 60 lakhs as a composition scheme, optional scheme, pay 1% or 2% GST. You will not be entitled for the credit. This is basically, everywhere this is the structure because administrative and practical difficulty in actually tapping all these small SSCs and go after them. It is impossible in a country like India. So composition scheme will be there, optional. But threshold could be only 10 lakh, maybe maximum 20-25. I mean, it also according to me is very high. Because of that limit only, distortion takes place because people try to remain within 25 lakhs and not reporting their turnover. So all these aspects are going to be, and then lastly, GST, a 10-step action plan, what you are supposed to do within the country, depending upon the corporate structure, GST steering committee, impact of GST on your business, implication on cash flows, option for GST impact optimization, then checklist for GST administration, compliance documentation and procedural reviews, accounting and ERP systems, liaising with customer and supplier, finally training of all stakeholders of your company, and lastly the transitional provisions. Because particularly this community may not be affected, but what about the manufacturers having the SENVAT credit available of VAT or CST on the date of transition to GST? What will happen to that? What do I take care of? What are the records I am supposed to maintain on 31st March 2016? All these are going to be huge issues because pharmaceutical companies because of the inverted duty structure are saddled with the crores and crores of rupees of SENVAT credit, which they are unable to utilize because their final product attracts 6% rate of duty. Their bulk drug attracts 12% rate of duty. That anomaly has continued for all these years and everybody cannot do the exports. Even if exports are done, it can be done only at the 6% and the rebate claim. So they are all saddled with huge amount of credits. What will happen to that credit on 31st March 2016 when the transition takes place next day? So these are the issues which will become very important. Next, last question. So friends, anyway, this is the video background. So be prepared for something after 1 year, and during this 1 year, during this period, it will be imperative that at the entity, business entity level, the impact of proposed structure, by and large the proposed design is very much on now cards. It is available on table. Based on that, one may have to evaluate how it is going to impact my business and what am I supposed to do to carry on my business in the same manner under the GST regime. Thank you very much.
If you have any questions, please share. Rather than mic.
Professional tax will continue. No, professional tax probably right now there is a no. Professional tax, as of now, there is no concessions on this. But our actually expectation is this: the professional tax will go. There is no specific mention of that, but that will go.
But you have not said anything about the brokers. What about the GST on brokerage?
GST
now we are service tax, so that will go and...
No, I said service tax, obviously excise duty, service tax, these are the taxes which are going to be subsumed in GST. So there will be total GST. So broker, the main broker, will charge to the client CGST and SGST both.
We can get the input credit also.
And you will get the full credit also. That CGST and SGST will be on your commission. Now here, because right now it is 12.5% only service tax. This may become 20% or 22% combined CGST and SGST. So that is an additional burden for the consumer. Now at that stage your commission, if it is remaining static, the extra tax burden will go to the consumer. And how far that will be. And that's why I said in the short term, in all the countries where GST is introduced, there is going to be an inflationary impact. It can lead to inflation in the short term. Because the tax burden could be heavy on certain items which are transiting from the current tax structure to the new tax structure. That will happen.
Sir, if I remember, you were the first person to inform us regarding the making the payment of the service tax on the own transactions. So will that continue in the new
Sorry,
own transaction, OWN, own transaction, proprietary transactions?
On transaction right now, there is the notional self-supply. As of now, the way that it is completely designed, it can become liable to service GST.
No, means we want.
It is like why I say supply GST is proposed to be levied on supply of goods and services, and there is no mention in the bill that it has to be for a consideration.
No, we are taking a credit of. We are not taking credit for the own transaction. Suppose
Right.
my total turnover is 100 rupees.
So you are not taking credit, that is right.
But for, what about then GST?
GST, that's why I say, okay, the moment you are subjected to even, if the stock transfer, which is to my own branch only, if that can become liable to GST, self-supply can also become liable to GST, but credit will be available. The problem could be valuation.
Well,
Particularly for manufacturers, for them that problem could be severe. Because no more. What they have done is, and we are slightly surprised because of that, the tax is as per the proposed taxing charging provision, 246 article which they have amended. As per that, it is a GST shall be any tax on supply of goods or services, excluding alcoholic drink for human consumption. Now, there is no mention about that it should be for a consideration. So, consideration is not a criteria. If consideration is not a criteria, then even my transaction with myself, when there is a supply, which is recorded, if I am consuming as an intermediate product, there cannot be. But if I remove the goods to my branch, I am liable. If I remove the goods for job work, I am liable. Similarly, if my self-transactions are recorded, it would be. But we are expecting a certain type of transactions which are in the nature of self-supply, probably they will be excluded from the GST. Some clarity will emerge only when the law comes.
At the moment, we are paying everything except the brokerage. We are not charging on transaction. So we are not paying service tax only
No,
on the.
I'm sure. Ideally, this system, at least as far as this type of transactions are concerned, I don't see any reason why it should be different in GST. But clarity will emerge after the bill is passed and the draft laws, draft legislations are actually moved, which will be in a very short period.
But the rebates will continue to be lost.
Yeah.
But on transaction, what we are losing right now?
That will. You see, the rule 6 of central credit rules, okay, where you have to proportionate the credit
Yes.
between your exempt supplies and your taxable supplies, activity or dutiable activity, principle of that rule 6 will continue in GST. It is continued all over the world. Because there are three important terms which you have to understand under GST. One is taxable supplies, one is zero-rated supplies, and third is the exempted supplies. Anything going for the zero-rated supplies, your credit entitlement is not affected. But anything going into the exempted supplies, credit is not available. If the input stage procurement of goods or services is used both for the taxable supplies and exempted supplies, then the credit will be available proportionately. So Rule 6 principle will continue in another form. It will not be so complicated as it is now. That will continue in the GST regime also.
Hope GST solves the problem instead of creating it.
By and large, GST could prove to be, if they do not mess up too much with the structure of the GST, the design of GST, then it can prove to be a quite boon to the economy. Over a period of time, on the long term, I did not go into that slide. Australia, New Zealand, Canada, 3 countries which we have selected. In all these 3 countries, the medium term to long term impact of GST on the economy, on the pricing level has been very, very moderate and very positive. Initially, the prices are likely to go up everywhere. Because overnight, service providers and manufacturers